We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to the Long-Term Investor, proud member of the Retirement Podcast Network. I'm excited to bring you a special episode that was recorded with my friend Adam Cmejla on his podcast, 2020 Money. In that conversation, we take a deep dive into the future of investing, specifically how direct indexing compares to mutual funds and ETFs. We also touch on tax strategies, portfolio planning, and why aligning investments with your long-term goals is so critical. Now, make sure to stay tuned until the end because I share something new that we're working on here at PlanCorp, something that I haven't even really had the opportunity to talk about on my own platform yet. And if you find some of the things that I'm saying interesting, I would love to have a conversation with you to tell you a little bit more about what it means and what it looks like to be a client of PlanCorp. There are links in the show notes at thelongterminvestor.com, and you can also book a call with me by visiting callwithpeter.com. Big thanks to Adam for hosting this conversation, and I hope you enjoy this episode as much as I did.
Welcome back to another episode of 2020 Money. Joining me on the show today is Peter Lazaroff, Chief Investment Officer of PlanCorp, and also one of the members of my mastermind group. Peter, thank you so much for being here. I appreciate you, man. Let's talk about something that I think is becoming a little bit more popular. Like, it's been around for a while, but I think as technology on the investment landscape has continued to improve and become more efficient, there are more and more people, advisors, investors alike talking about this idea called direct indexing. And for longtime listeners of 2020 Money, yes, I am taking a little bit of a, dare I say, right turn, because out of the 300 plus episodes of 2020 Money, I can probably count on I might need three hands, the number of episodes that we've done that have been directly related to investing, period, full stop. There's obviously no shortage of shows out there. Peter's show is a great one to consider listening to. Not consider, go listen to it. I don't know why I gave any sense of hesitation there.
Just go ahead, stop the episode right now and go to my show, The Long-Term Investor, then come back and listen to us.
Then come back if you feel like it. If you feel, go listen to Peter's and then come back here if you feel like it. In all seriousness, we don't do a lot of episodes on investing because, again, candidly, our angle has been how to utilize the business and profession of optometry to plan life on purpose and utilize that to build wealth, protect your wealth, grow your wealth. But as longtime listeners know, I'm a fan of saying that your optometry practice is two unique and distinct things to you. It is a conduit for cash flow, and it is also an asset that builds enterprise value on your personal balance sheet, with the intention, at some point, I would assume that every practice owner listening is going to want to sell their practice for a gain. An investment or an optometry practice is an investment. It is a company that we own, and we should be able to sell that business for an investment. One of the byproducts that happens whenever we sell any investment, whether it be a business that we own, a stock that we own in a brokerage account, a mutual fund, an ETF, a bond, whatever investment that we own, what are the two certainties in life? Death and taxes. And so we're not talking about death here, we're talking about taxes. And so to bring this back full circle to what I mentioned in the beginning, the direct indexing approach, while it's been around for a long time, has seemed to pick up a little bit more steam. And it goes by a lot of different names: direct indexing, SMAs.
Those are the two big ones. They were SMAs, or separately managed accounts, for institutions, big institutions, like decades even. But yeah, you're right. The technology has gotten to a place where the costs have come down where the average investor can access it, which is crazy.
As this has become more popular, let's just give some context and backstory to what is direct indexing. Let's just start there and give a basic definition of what it is and how it's different than the quote unquote traditional investing that your average investor would be used to.
Let me give you the one sentence. Hey, your audience probably wants to be able to tell time. And that's what I'm going to say first, and then we'll get a little into how the watch works. But to me, direct indexing is like owning a mutual fund or an ETF, but with just one person. Imagine you and me own shares of a S&P 500 index mutual fund. The mutual fund is going to combine our funds into a single pool of assets that own the underlying securities of the S&P 500 with the explicit goal of tracking that index. And so you and I in the fund together, as well as thousands of others, we're going to share all the costs of that fund. And those costs are the commissions of buying and selling the individual stocks that are within the mutual fund. It's the bid-ask spreads. It's the market impact. It's taxes. And I think the taxes is the really important piece, because when mutual fund managers tend to deal with investors in cash, it means that they're selling their securities to raise cash for investor redemption. So again, you and I are in a mutual fund together. I need to withdraw or I need to sell something either because I'm rebalancing or I'm using my portfolio to fund lifestyle expenses. And the mutual fund manager just has to raise cash. And just like when you and I and our clients have to raise cash from their portfolio for any number of reasons, they're capital gains. Each day, mutual fund managers are doing this. And so as you continue throughout the end of the year, what happens is that you are given, at the end of the year, a tax bill. You're given a capital gain distribution. Not always. In a year like 2022, when markets were down, those funds were able to sell things at losses and minimize that capital gain exposure. If a lot of your listeners own the total stock market index or an S&P 500 index, there's no doubt that the capital gain distributions are going to be lower than if you own a actively managed mutual fund, but they're still there. With ETFs, and this is where we're kind of getting into a little bit of how the watch works, but I swear I won't go too deep unless you follow up and take me there. The exchange traded fund versus a mutual fund, it's a little different because there's this authorized participant that acts as a middleman. And basically, if I'd like to buy shares of a S&P 500 ETF, my cash is sent to a brokerage firm that's sent to this authorized participant who basically delivers a basket of securities to the ETF. And so when I go to sell my ETF shares, the ETF is going to send a basket of securities that is going to create the least tax impact for the whole group. That can be a somewhat complicated topic and concept. So let's not even worry about it. And let's talk about what the SMA does. The SMA is a mutual fund or an ETF for one. And you will go to a manager, whether it's a Vanguard or a Dimensional Fund Advisors, or there's dozens of people doing this. And you give them cash or even cash in securities. Maybe you own Apple or United Healthcare or something for a long time with big gains. And the problem with that is that here's this position that's done really well, but it doesn't strategically fit into your asset allocation. And so you might go to the fund manager and say, hey, I would like the total US stock market exposure. And maybe you give them $1 million cash. Maybe you give them $500,000 cash and some NVIDIA that you hit a home run with, or Apple, or I always say United Healthcare because I know you're working with optometrists. I historically have worked with a lot of physicians that were, for some reason, forced to buy United Healthcare early in their career, and yet they're still holding it and they made a killing on it. Why would you have an overweight to one company if you don't need it? Why have that single stock risk?
Why have that concentration risk?
Yeah, and the fund manager will build around it. But again, keep it simple. I'm already getting distracted. Let's pretend we're giving them cash just like you're going out to buy an ETF. If you have the choice of buying Vanguard Total Stock Market Index, VTI, or giving it to a manager to do a direct index, so it's basically they're doing the same strategy, but it's just for you and not for hundreds of thousands of others, you aren't sharing the cost with hundreds of thousands of others, but there's a tremendous benefit in the way that you can manage the taxes so that it is technically lowering the overall costs. And then it can be very beneficial if you are doing good financial planning around it.
Great explanation and very succinct in being able to kind of delineate between mutual funds, ETFs, and then the separately managed account or the index for one. I love that approach because at least I was able to visualize that. I assume the audience was as well. The way that I've thought about this is you're essentially unwrapping the index. You're allowing the investor to own everything that's happening within the index fund. And if that's your approach, if you view yourself as an indexer, this is an approach to consider for your investment philosophy going forward, because from an investment point of view, your investments should be tied to a goal. And investing without a plan, that's a whole nother conversation in and of itself. But everything that we do with our money should have some type of goal attached to it and some type of plan. And that's where there's these two separate lines that I think of that are converging for investors. The one line is their ownership journey in the practice that they own. And then the other line is their investment experience that they have as an investor. And eventually, those two lines will intersect. And my visualization of this mentally is the intersection is the year in which they sell their practice. In the absence of having any type of capital losses that they're carrying forward from previous years, it's not if, it's to what extent the sale of that practice is going to be taxable, how much of that is allocated to the asset side of the sale, how much of that is deemed the goodwill and the long-term capital gain side of this. But there is the tax loss harvesting approach that is part of that investment line that I talked about, that somebody can make that decision to tax loss harvest or not. Like the one extreme angle of it is you are a true buy and hold investor and you never sell ever. You're just DCA, dollar cost averaging, every month, every quarter, every week, like whatever your frequency and cadence is, as an investor, you're just investing every single time. And when you get to the point of retirement, your portfolio is this, you never sold, great, good for you. You embrace the power of capital markets. Awesome job, your portfolio is worth X. The next iteration of that is somebody that is still investing in index funds, but they're taking a little bit more active approach as an investor themselves with their portfolio. So they're looking at, I talk about this as, what should your pie look like? You want this much to large cap growth, this much to large cap value, this much to international, this much to emerging markets, this much to crypto, to real estate, whatever your asset allocation is. And you're looking at this in the form of sleeves or the rebalancing approach. So I want my exposure to large cap growth to be X%. And if it gets over that, I as the investor, not as the fund manager, but I as the investor and the manager of my own portfolio, I'm going to say, ooh, I'm a little bit over concentrated here. Hey, let me exercise the fundamental rule of investing. Buy low, sell high. Let me sell some of my gains. Look in my portfolio of ways that I can offset those gains with losses. Is there something that has underperformed in my portfolio? Can I sell at a loss, offset those, and get my portfolio back to the target allocation? And then there's this emerging approach that, as we said, technology has opened it up to be a little bit more widespread on the direct indexing approach, which allows you to take this idea and this concept of tax loss harvesting. Do you agree with how I teed that up and thought about the different avatars of investors? And can you talk a little bit more about how this direct indexing approach and tax loss harvesting kind of reconcile with each other?
I wrote down a couple things as you were talking, one of which has a little bit less to do with everything else, so I'm just going to say it. I want people listening to realize that accumulation is very different than decumulation. You can listen to podcasts like yours, Adam, or mine. You can read books. And the formula for accumulating wealth is well known and not very hotly debated at this point. Decumulation is very difficult, very personalized, and there is a lot of mistakes you will make and you won't even know you've made them. Sometimes you will, and then you'll kick yourself, but you won't know until you get your tax bill. I feel like index investors in general are some of my favorite people because, one, I'm an index believer personally.
The one fund portfolio, right?
Yeah. Anyone who goes to my website, you're going to get this little pop-up who's like, how does Peter invest? I'm even pretty sure there's a howpeterinvest.com URL if you're really curious. But I own one fund. I don't think it needs to be that complicated. I help oversee $7.5 billion, but I feel like for me, simplicity is the answer, in part because I don't have time for myself. I take care of others. And ultimately, good investing is boring. And the way that that used to look was buying a mutual fund, emphasis on mutual fund index. Then fast forward to the 90s, and there's this new vehicle called the ETF. And definitively, the ETF is more tax efficient. And if you're plowing dollars into a mutual fund rather than an ETF, please stop doing that. What I find is a lot of my listeners, they have index portfolios and maybe they have some of their assets with a manager because they appreciate the financial planning. What you need to realize about direct indexing or a separately managed account, or I'm just going to say SMA from here on out, and hopefully I'm not being overly jargon heavy by doing so, but this is the next evolution of index investing. In 2017 was the first time that cost of these vehicles dropped to a level where I felt like there were a certain type of investor profile that it made sense. And we're talking maybe 35, 40 basis points to get total US stock market access, something that's going to track the Russell 3000, for example. That's expensive relative to, at the time, Vanguard offered the same product for, I think, 4 basis points. Now they're down to 3, but history lesson. A lot of people didn't like the idea because of the cost. And so we talk again about sharing costs in a mutual fund. Yes, there's the expense ratio. There's also the tax cost. There's also these implicit costs that we would need another 2 hours to talk about that nobody sees because there's no such thing as free. But again, 2-hour conversation we can have another time.
That's a deep dive bonus episode for those listeners that, no, I'm kidding. We're not going to do that.
That's right. We'll only put it on YouTube, but it'll be on a hidden channel. This is the next evolution. And now you can do direct indexing for, depending on the size of assets you're working with and the strategy that you're following, you can do it for anywhere between 12 basis points or 0.12% and like 0.2%. I think most people are in that range competitively with the big managers. That's not that different than an index fund. And the benefit that you get from a tax perspective is really, really powerful. And let me explain a little bit more how that works. Imagine you go to a manager, Vanguard, Dimensional Fund Advisors, BlackRock, whomever, and you say, here's $1 million. I would like the Russell 3000 returns, please. And they say, okay. You say, also, though, I want you to make sure that you get a lot of tax loss harvesting losses for me. I'm cool with the idea that I don't track the index perfectly if you give me more losses. My personal experience guiding clients to these dates back to 2017, and the data would support this. These managers are pretty good at tracking indexes, whether you want losses or not. And so they're going to go out and they're not necessarily going to buy all 3,000 companies in the Russell 3000. They don't actually need to. And when you think about it, the top 10 stocks make up 33% of the index. So right there, the stocks that make up 1/10 of the index aren't that important. You can do something through optimization rather than replication. Those are technical terms that the fund managers use, even for their ETFs. There are S&P 500 ETFs that use optimization rather than perfect replication. But they use optimization with SMAs. And so when Coca-Cola is trading at a loss because they had a bad earnings report or something, they can sell Coca-Cola and go buy Pepsi, or sell Johnson & Johnson and buy Pfizer, or sell ExxonMobil and buy Chevron. And what you're doing, it's the same concept as when you're tax loss harvesting at the fund level. For example, maybe you're selling your S&P 500 ETF and buying a Russell 1000 large cap ETF in its place. You capture the loss, you sit in this fund for at least 31 days, and maybe you rotate back into your preferred fund. Maybe you don't. Dear index investor who is listening to us, if you want to capture losses, you have to wait for the entire index to be down. Adam, I can send you something for the show notes if you want to use graphically. It's not like a Peter Lazaroff original. It comes from an outside provider, and it just shows you what percentage of the index is down in a given year, and then what was the market return that year. And so you see in up years, even 40% of individual stocks are typically down at some point. That's a tremendous opportunity to tax loss harvest. And I wouldn't say we're dancing around the fact that these are awesome from a tax planning perspective. But dear index listener, imagine you own an optometry practice, perhaps, and you think that you might sell that practice. You know that a capital gain is coming down the pike. And so you could choose to continue to plow money into ETFs and mutual funds, tracking the whole index, and just be prepared to pay that capital gain bill whenever you sell the practice. Now, maybe you aren't going to sell the practice, and we can touch on that too. But ultimately, why wouldn't you be banking losses to reduce the tax liability? And yes, maybe you're paying, I'm just going to say a random round number, 15 basis points more per year. Let's do the math on like $1 million capital gain. I'm pretty sure you're going to pay more than that. Not everybody knows that they're going to have a big capital gain coming down the pike. And so when I think about the clientele that I work with, which is less focused than your practice, you have deep expertise in this area. And I know your practice well. It's why your clients love you. It's why you're respected in the space. It's that not everybody has a big capital gain coming down the pike. And some people do and some people don't. But let's imagine that you don't have a capital gain coming down the pike. Why are these tax losses valuable? Sure, you can write off $3,000 of income every year. Great, but not that interesting.
It's amazing that number has not increased. It's been 3,000 for how long? The one number that never gets an inflation rate.
Everything else is getting inflation indexed. What the heck? Come on, guys. I'm not a political person, but come on, let's do that. This is going to be my political campaign. I believe teachers should not pay taxes. And I'm going to now run on a second thing that the capital loss forward should go up.
Amen.
With that aside, ultimately, even if you don't have a big capital gain coming down the pike, you are going to rebalance. Life is uncertain in the sense where you can't predict what sort of gains you might come. And if you're going to live off your portfolio one day, that's going to have gains. And I feel like this goes, I get to full circle. This is exciting. That goes back to why accumulation and decumulation are so different. So you're in retirement, and what you have the day you retire is what you have. And tax management is extraordinarily difficult. You can't make taxes disappear unless you did good planning in advance. And so there's a lot of planning, obviously, with moving money around, whether that's like Roth conversions or the way that you charitably give, or accelerating or deferring income, especially at like the end of your career, to try to like spread out tax impact. I don't think anybody's going to be upset getting to retirement sitting on a whole bunch of losses that they can then keep the gains lower. It can make a Roth conversion strategy more effective. It's really endless. And so I think that's the big benefit. There are other reasons that you can direct index, but to me, that is why this is the next evolution. I think that you should take note that literally every major asset provider, I said Vanguard, Dimensional, BlackRock, but it goes deeper. It's Goldman, it's Morningstar, it's American Century. Everybody is doing these because it is the next iteration from mutual fund to ETF to direct indexing. And one last thing I'll say, and then I'll take a breath. I think in general, when there are new ideas, they can be difficult to wrap your head around. What is the risk, in my opinion, of this approach? The risk, I suppose, is that at death, the step up in basis goes away, which, to be clear, is a risk for everything. And the natural outcome of a portfolio where you're harvesting losses and holding the gainers means that you're going to have a very low basis portfolio. On the other hand, it is going to be diversified. On the other hand, there are some really, really cool stuff you can do with a super mature SMA 10, 15 years in to simplify it. But that would be the big risk, in my opinion, is that at death, you have 500 to 1,000 holdings that just shows up as one line item on the statement. I've watched people go through their estates with it. It's not difficult to deal with at all. But if the step up in basis were to go away, you are in this sort of wrapper for life. But again, I'm of the opinion that this sort of wrapper is the future.
I do want you to unpack the super cool thing that you can do in 50, for a matured SMA. I am curious to hear your thoughts on that. I think, to your point, the hesitations and reservations that we have along anything new, our natural instinct is to be cynical and possibly skeptical about it. It's like, what's the catch? This sounds great. I get to own the index. To be clear, we're not saying it's free. It's not the exact same cost as an index fund. There are explicit and implicit costs in that: trading, tracking error, bid-ask spreads, et cetera. But everything in life from a financial planning standpoint is about weighing the benefits and exchanges of the decisions that we make. And to your point, eventually the portfolio becomes the plan. One of my episodes that I did a long time ago, years ago, was the 4 levers that you can pull towards your financial independence: how much you save, the delta between now and when you want to retire, how much you spend in retirement, and the rate of return on your investment. Basically, it's the time value of money equation. Let's just call it what it is. But to your point, Peter, when you get to that point of capitulation where you're now on that summit of climbing a mountain, you still got to get down. And that can be the more complicated part of planning, is the decumulation mode as opposed to the accumulation mode. So when the portfolio becomes the plan, that's where some people might be thinking, well, so I'm going to do this direct indexing thing or this SMA approach. Again, we're using those words interchangeably. I'm going to have 1,000 positions. My statement's going to be 150 pages long. My 1099 is going to be 900 pages long. I don't want to sign up for that. That sounds complicated as heck. And then to your point, the hard part for us to all think of is cognitive decline. And as I age, like, who's going to take over this? If I am investing myself, is my wife or my husband going to be able to do this? How do I find somebody to manage this? Beginning with the end in mind, I don't want to create something right now that sounds great only to have it be a challenge and an obstacle down the road.
I'm not going to dispel any of it. I think it's good that we're talking about it. I think the risk is perception of more complication. The thing is that, again, it's a different wrapper. We do tax returns at Plan Corp. We have clients who are in SMAs. Yes, they have very, very long 1099s that they download and then they upload and then they never see them again. If you're doing your own taxes, please stop.
Especially as a practice owner. I mean, if you're doing your own taxes as a practice owner listening right now, do not pass go. Stop listening to this episode. Don't even go listen to Peter's episode.
Hey,
find a CPA. I'm just kidding.
No, it's okay.
Get that off your plate.
I agree. The risk is that you're introducing a little bit of complexity, which I'm pretty anti-complexity. And so I think in general, that to me tends to be the thing where I get the most questions. Now that the cost has come down, I get less questions. And let me be 100% clear. If I had $1 million cash today myself, which I do not, it would be going into a direct index. Full stop. Take that for whatever it's worth. As someone who all my money is really just in tax deferred stuff now, I'm being candid about it because I tell you, like I publish it everywhere. And again, I think the URL is howpeterinvests.com. The reason I say all that though, is that to me, it's a no-brainer. I used to say that there were better use cases than not. Let me talk about people who maybe are not a good use case. Not a good use case is that you're in a low federal income tax bracket. You don't have any capital gains, whether it's from a liquidity event or whether it's from most of my assets are not going to come from liquidating a taxable portfolio. That's not a good fit.
You're not doing this in a Roth IRA.
You could. The only reason you would, and I'll put this out there, is if you have like really strong environmental, social governance preferences that you want to express through your portfolio. That's the long way of saying ESG, the environmental, social governance investors out there. There is no better way to customize in a manner that doesn't hurt your diversification or probabilistically set you up for lower expected returns than using an SMA. But yes, you wouldn't typically use it in an IRA, maybe if you had an SMA of bond holdings, but let's just stick with the stock because if we go into the bond world, we'll lose everybody. The other thing that you mentioned is cognitive decline, which I see every day. We work with a lot of people. The data shows it starts at 60, but the data shows it really, really picks up at 70. And it's sort of like if you put your hand in boiling water or in water and start to heat it up, you're not going to feel it get hot until all of a sudden it's boiling.
The frog in the pot.
Yeah, frog in a pot. You do have to worry about complexity, but you do also have to take these steps now so that you are setting yourself up for success. I don't know an individual investor who does SMA investing on their own. I think your level of wealth to have a fund manager take your money is in what the industry would call the ultra high net worth area, like the $20 million portfolio and up. You could probably find a manager to do it for you. There might be some, for lack of a better word, handcuffs to the situation, but you could certainly do it. But there's some fun use cases in setting these up too. If you've been investing for many years, one of the things I said at the outset is perhaps you're going to contribute a combination of cash and securities to the SMA. Adam, you're actually a pretty tidy guy and organized, and we've traveled together. And so I know some of your behaviors. And I think in general, this may not apply to you, but like I have a messy closet. It's messy. What I do know probably applies to you and every other human listening to this is that there are things in your closet that you do not wear and that you look at and you think, gosh, I should really clean out my closet. And then every blue moon, you do clean out your closet and it is so good. That feeling when you walk into your clean, organized, things I don't need are gone closet is gotta be one of the most underrated feelings that you can have in life. If you haven't done it in a while, maybe go do that after you do all these other things Adam and I are talking about. But here's the thing is it does stay immaculate for a while and then it starts getting messy again. A really fun use case, if you feel like your portfolio is a bit like a messy closet, you can take positions you've held for a while and don't like necessarily fit with what you're doing. And to be clear, actually, this only applies to individual stocks and ETFs. So if you have individual stocks and ETFs, you can put those along with cash into an SMA that is very strategically managed. And something you said earlier, Adam, is that there should be an objective to your portfolio, to your specific investments. And look, sometimes it just becomes a dirty closet. A shirt's still a shirt, but you don't want to wear that shirt anymore. You don't want to have to pay to get it out of your closet, but this is a fun way to do it. And honestly, when you open your statement and you have all these holdings, we have a lot of emotions, obviously, and it makes us do silly things with our investments. And this is an opportunity to simplify the portfolio because yes, under the hood, you have 1,000 holdings, let's say. That's actually true of your ETF as well. On your statement, that you get from your advisor, all you're going to see is one line item. You're going to see a clean closet, and you're going to know what that one line item's purpose is. And one of the things I am really passionate about when it comes to portfolio construction is that factor. It goes beyond financial theory, and it goes into real life experiences that I see in a daily basis working with people and being a fellow human with you. And so I think that's a really underrated piece of all this.
I didn't want to sugarcoat and hide some of the concerns and reservations that people would have, dare I say, drawbacks, perceived or actual drawbacks to an SMA approach. I think the point that you and I are both emphasizing, in spite of those things, it is still the evolution of investing. And to your point, this is the mutual funds to ETFs. This is that continued next wave. In spite of those things, every investment has benefits and exchanges. For a general investor that doesn't know whether or not they're going to have some type of long-term capital gain in the future, or the tax alpha when we talk about investing, and with everything in life, I don't care what you make, I care what you keep. And when you look at the investment returns that you get for investors that we are talking with, both in our respective firms, taxes are a part of life. And it's not if, it's how much that you pay. And so if you have a return, that's great. How much of that are you actually keeping after taxes? And for a lot of the listeners of this show that are practice owners, that's where I throw myself under the bus and get really self-critical, because it's hard for me to share this without almost sounding it like a commercial. But I'm trying to understand why a practice owner wouldn't at least consider doing something like this. Because if you're managing your practice with an eventual end goal of selling the business, you know there's going to be some tax liability. It's not if, it's how much there's going to be. And when we talk about the net return of what are you going to have after you sell your practice, after advisory fees, like your consultants, brokers, whoever that might be, after taxes, and you have use case A and use case B. Use case A is our situation that we talked earlier, dollar cost averaging into mutual funds, or again, hopefully you've switched over to ETFs, at least in your brokerage accounts. You've never sold, great. You've got this portfolio, and then you sell your practice. You have nothing to offset the gain from selling your practice. You're going to have a tax bill. Use case B is you do the exact same thing on the investment standpoint. You talk to an advisor, to a manager, you have this conversation, you build a portfolio that is in alignment with the type of goal and the type of plan that you want, that you're aspiring to create, the amount of money that you need at retirement to live the life that you want. And whatever that rate of return, whatever that portfolio construction looks like, that's the portfolio that you build. And yet you're still able to build up these capital losses on your personal balance sheet. And then when you sell your practice, have X numbers of tens, potentially hundreds of thousands of dollars. Again, I'm not making any promises.
Yeah, we don't know what tax rates are going to be, so we can't promise.
We don't know. Correct. But all things being equal, just that one angle alone, I don't know. Have I made my case?
Totally have made your case. It's a no-brainer. If you're sitting on a lot of cash and you're considering putting money into the total stock market, or just any into the stock market, I think in general, it's worth noting that this strategy tracks indexes better in the US than non-US because of some underlying features. But so if you have a large sum of money that's earmarked to go into US markets, this is where it should go. To me, the costs have gotten low enough where it's not really a debate. Back when I personally was really using them, and when I say using them, sparingly, the use case wasn't as relevant because the cost was so high. It's basically a no-brainer here. Another great feeling, maybe even better than a clean closet. And this hasn't happened to me since college because I'm old and not cool anymore. But when you find a band that you get to tell everybody about, it's a good feeling. I got a friend who was telling me this week, I don't have any cultural capital because I can't tell any bands. Although then I gave that person an amazing restaurant recommendation and was told last night that I, in fact, do have cultural capital. But this is like the same thing. We're telling you about something where like people know about this band. They are using it now. If this is the first time you've heard about it, chances are you will get to tell somebody about the band and you'll be the cool kid. The really cool thing, now this is cultural capital. I'm going to make sure that this person listens to this podcast so they can hear me saying that phrase. It's what do you do if there is a scenario where there's no step up in basis at death? If there is a scenario where because you're always selling the losers and holding the gainers, you have this portfolio that is extremely low cost basis and is a little bit harder to track the index because you suddenly can't buy and sell the way that you would need to. There's something called a 351 exchange. This is my cool strategy. You guys are like at the ground level of finding out about a new band that everyone's going to think is so cool. And then your cultural capital is going to be through the roof. We're actually getting ready to do one in the first quarter of next year. And so when an ETF comes to market, it is typically funded with cash. It's cash from investors. It's cash from the company that is putting it out there into the world. And then it's cash from new investors. ETF's live, people buy it, cash goes in. A 351 exchange says that you are allowed to fund an ETF with securities. So picture your 10 to 15-year-old SMA has very low basis, and you're a little bit worried about its ability to track the index any longer. You can, when a fund is coming to market, and it does require working with an advisor, and it does require that advisor knowing about a fund coming to market that will allow it, you can roll those securities into the ETF and just get an ETF back. So let's go with an example where, let's say today, I put $1 million into an SMA that's tracking the total US stock market. And I'm very happy about that because that would be great. It grows. And in 10 years, even though I'm not going to know what the compounding, how reasonable this is, but in 10 years, let's say it's worth $10 million. My basis is $1 million. So I have $9 million of capital gain, probably. Now, I've been banking losses, but I don't want to have to use those losses because I'm going to sell my practice in 15 years from inception date. But there's an ETF that's about to come to market that's total US stock market. And I take my basket of 1,000 securities, I give it to the fund manager, and they give me back $10 million in shares of a single ETF. And that's how you clean the closet.
And your basis would be?
Your basis would be the $1 million. Now you have $10 million in one holding.
But at least you've cleaned it up and now you're tracking the index. So you're solving for correlation or you're solving for diversification.
Right. And so it's actually a great strategy if you happen to own a single stock. Totally different topic. We were talking about hitting a home run with NVIDIA. I wrote an article for the Journal of Financial Planning this year that talked a lot about how to get out of concentrated stock positions without taxes. And when I say get out, I mean diversify away the risk of a single stock. There's no avoiding taxes. There are differing degrees of ease with which you can do it. A 351 exchange is something I didn't put in the paper because it's not something that all people have access to. The future is now with SMAs. What I think the future 10 years from now will be everybody has these SMAs and the same fund managers who are providing them are going to launch funds for people to do 351 exchanges into. You heard it here first. You now have the cool band. There have been 80 such transactions, maybe a few more in the country that have allowed for this. SMAs have become more popular over the past decade and this situation is arising. Part of it is that people finally realize that owning individual stocks is a bad idea, especially when they're concentrated. That's probably the next step that you would be talking about 10 to 15 years out from launching one of these. There is another strategy, but that is a little more esoteric. And I'm not even sure if 351 is too crazy. At least we're near the end of the episode. So if people have gotten bored with us by now, they didn't even get to hear it. They didn't even get to hear about the cool band. You never know. We're going to tell you about the new cool restaurant. That would have been the other analogy, I guess. For me, it was always a lot of pride telling somebody about a new cool band.
So is there a band that everybody would know or that is on the radar that you discovered and shared with people?
I don't know if it's on the radar, but I felt like I was very early to the game on Death Cab for Cutie, which is not very big now, but I felt like at the time from like before Postal Service came out, which is the same singer, I was listening to Death Cab and that was my earliest call. That's like making a stock market call too. There's so much emotion and ego and all this stuff. The way I think if we're going full circle on it is you said it yourself. It's not what you pay, it's what you keep. I think this is a great strategy for maximizing the amount of money that's in your pocket. It is a great strategy for cleaning up the closet. It's a really good strategy for people who are in a high federal income tax bracket or have a known liquidity event that will lead to a capital gain in the future. Do you need 10 years of banking losses? No. I mean, we do this all the time with people who are going to sell 1 year from now because actually most of the tax loss harvesting value comes in that first year, and then it sort of diminishes over time because, again, you're holding the winners and selling the losers. And so I think it's a pretty clear use case profile, in my opinion. And I think as more and more people learn about it and become more comfortable, it'll just be like when ETFs became the norm, in my opinion.
Peter, this has been a very enjoyable conversation. Thank you so much. I think that is a great place to put a pin in this episode. We will put links to all of the resources. If you can send me that chart, because that was something that we hit on verbally, but I think it would be great to complement that from a visual standpoint, because I feel like investors underestimate just how concentrated the returns are in the index. There's a reason that we hear of Fab 5, the Mag 7, and things like that. BRIC, FANG. I mean, the acronyms change over the years, but there's a reason that those acronyms are there. It's because a significant part of the returns in indexes are concentrated to a handful of holdings. We've talked about this ad nauseum in this episode, but I would like to put that visual in the show notes for those that are looking to see as a complement to how we shared it verbally. So thank you so much for taking the time to come on the show. Again, if you want a copy of Peter's book, check out the show notes. Click on that link. He'll get one out to you. Wonderful writer. I've followed your work for years. I still remember hearing the first episode on the Kitses podcast. And then lo and behold, the number of golf trips that we've had. I've certainly appreciated our friendship and what I've learned from you over the years. So thank you for allocating the time and coming on the show.
You are very kind. The feeling is mutual. I appreciate being invited, and we'll come back anytime for you.
Sounds good. All right. Thank you again, Peter. And we'll catch everybody on the next episode of 2020 Money.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.